Good afternoon, ladies and gentlemen. A very warm welcome to our hot topic, Hidden Champion or Bubble. We have 40 minutes together, and we will reserve some time at the end, around 6-7 minutes, for your questions. So as we go along now, I would like to encourage you to already think of the challenges and the questions you want to ask the panelists later. My name is Manuela Froehlich. I lead fundraising at Align. It's a private debt GP, and we are focused on senior secured lending to film and television productions. I'm also co-founder of Forefront, the leading career network for women in asset management and finance in DACH and Luxembourg. And so in both roles, this topic of private markets or private debt is very close to home. That's why I'm really happy to moderate it here with my esteemed panel. Let me introduce the gentlemen now up on stage. Henrik Adam, country manager Germany and Austria at Rothschild & Co., representing the sales and product specialist view on the panel. Henrik says, in credit, returns are not made by taking risk. They are made by discipline and by being very deliberate which risks you are refusing to take. Welcome, Henrik. Great to have you with us.
Thank you. Hello.
And you're allowed to applaud now if you want. There you go. Next to Henrik is Nicola Mauri, CIO of Valeur Group, an independent advisor for institutional investors, and he's based in London. Nicola has a clear view. Hidden champion or bubble, it doesn't matter. Active management and truly tailored advisory are what count in this complex and evolving asset class. There is no room for passive exposure and generic solutions. Thank you for joining us today, Nicola.
Thank you very much.
Then I would like to welcome Serkan Mirza, the CEO of Credit Exchange, an exchange for mortgages based here in Zurich. And Serkan shares his strong opinion. Direct Swiss franc mortgages are safer investment than US Treasury bonds. Welcome to the round, Serkan. And completing our panel is Robert Scheer, co-head private credit origination at M&G Investments in Frankfurt. Robert believes private credit isn't about finding the next champion. It's about avoiding the losers. Very true, Robert. Glad to have you with us. So before we dive in, let me quickly understand the room. How many of you already have an allocation to private debt in your portfolios? All right. And who is currently evaluating exposure or increasing it? Yeah? So perfect. That tells us we are not theoretically debating here today. Private debt has really evolved from a niche allocation to a structural component in many institutional portfolios. Capital inflows are significant, fund sizes are growing, and expectations remain ambitious. But with scale comes scrutiny. Is private debt truly a hidden champion of long-term allocation? Or are certain segments showing early signs of overheating? This is exactly what we want to explore today. Let's kick it off. Each of you looks at private debt through a very different lens. What defines your approach to private debt in the current environment? Henrik, if you would like to start.
First of all, thank you for the introduction. Yes, actually, I'm working for Rothschild. Rothschild had this kind of 5 hours arm, which is the private market platform. And we are doing private equity and corporate direct lending. And therefore, the focus is very much on the corporate side. And I think what makes us special is, or like specific, that we really look at this wealth preservation. I think we are obsessed about risk management. And that's what I also said in my intro, that it's even more important than before to avoid any risk and to understand every risk. And therefore, a typical due diligence is taking 3 to 6 months. Therefore, we go very deep into the companies. We might hire somebody who was working in this area before on the company. So we do really understand what kind of risk we underwrite at the end of the day. And to give you an example, at the end, there's always an investment paper that has to be presented at the investment committee after 3 or 4 months. And this typically is like 120, 130 pages long. So that really shows that you're going quite deep into what you're doing.
Right. Thank you so much. So to make it a bit mix up, now next is Robert. How does your daily origination lens look like, and how do you approach private debt?
Yeah, not really mixing it up, because I'm also looking after corporate direct lending. So yeah, our focus really on direct lending to corporates, usually with a sponsor background, in the mid-market, which we define as EBITDA anywhere between 10 and 50 million. And then with a pan-European focus, but pretty much a focus on the German-speaking regions, the Benelux, and UK and Ireland. I think where we are slightly different than vast majority of the pack is we're sector agnostic. So we're not chasing trends, really bottom up, and our approach really pays off if you're watching the headlines these days. And the other thing is that we're focusing on senior direct lending. Well, I mean, everyone understands something different under that term, but for us, it really means from a risk-return perspective, playing inside the more mainstream, I'd say, unitranche, which really tallies well with our insurance heritage. And maybe last word, because you're saying in the current climate, I think for us, we can truly say that we've been following this approach for, ever since we entered the asset class, really, because I think, style drift can be quite a topic in that asset class.
Great, thank you. Nicola, from your advisory angle.
Yeah, and at Weller, we look mainly to advise clients in the family office and smaller and bigger investment professionals. And so we have a different lens. We look at what is going right now. It is higher dispersion and more need of selection. So what we look is specifically what the managers and who is underwrites, what are their capabilities, what are their skills, what they bring as skills in the portfolio. We have a very much, we look at it as a total portfolio approach. So private credit is still risk, and it's credit risk. So in that perspective, we need to see what adds to the risk portfolio. And we see that in a variety of different structures that private credit can give. For example, starting from CLOs to more underwriting of direct private credit, and in there where there is better relative value. So there is a lot of dispersion, and it's seen as a one single asset class, but there is quite of alpha to extract from allocation.
Thank you so much. And Serkan, from your view.
Well, simply said, we're an exchange for mortgages, and we connect financial institutions on both sides of the market. Financial institutions can issue, so originate and trade and invest in mortgages, both in a white-labeled form on the distribution side, but also a bond-like investment on the investor side. So effectively what we have done is we created a financial market infrastructure for Swiss franc bonds, for Swiss franc mortgages that are traded like bonds. Thank
you so much. So we had this before when investors talk about private debt. Robert, you said it quickly earlier, that often means different things. What is the most misunderstood about this asset class, Henrik, from your perspective?
Yes, as you mentioned, that there's a lot of misunderstanding if you talk about private credit or private debt, and often sometimes private credit and private debt is mixed, and you have to explain it from the beginning, because in this asset class, there are so many asset classes included. We only talk about, I think you have the on the asset-backed side, and also even on the corporate lending side, you have the senior, you have the junior. Then there's unitranche investment. There can be especially facility lending be. Then there's distressed mezzanine. So there are so many different angles to look at it, and with so many different risk profiles that you cannot compare it. So you have to be really precise in what kind of risk do you want to have it, you want to go, and then you have to go deeper. But I think that's the biggest misunderstanding. And I think also that people really sometimes think that private debt is high yield, but just on the private market. Mm-hmm. But there's so much, I think, behind it. I think managing a high yield fund is really completely different than managing a private debt fund, because you go so much deeper into each underlying assets with its due diligence. You can structure it, you have documentation, you have covenants against it. You can even in a bad scenario, usually you trade the risk away if you have some problems in the public market, but on the private debt side, you can take the keys and you can restructure the company on your own, which is really a completely, I think sometimes a lot of people don't know that there's a huge advantage on the private debt side.
So it's very important to look under the cover, basically. Robert, you started already saying that's a different. What else can you add to what Henrik said?
Yeah, I mean, I would echo it because, like, what we are often seeing, like, even if we speak to like very sophisticated institutional investors, you know, again, like everyone means something different. So we often spend quite a bit of time saying, like, you know, private credit isn't equal to unitranche, which often is the perception, right? Unitranche is also not necessarily a senior product as it is often being sold, right? Because it's by definition a blend of usually a senior piece and a subordinated piece. So lots of confusion there. That's the first thing I would mention. The second thing is, I think private credit is often perceived as a very complex product, right? Something very esoteric. People don't really understand what's behind it. And I would argue at the end of the day, I mean, what I'm doing all day, albeit that I'm undermining my own position here, is it's pretty vanilla. It's pretty straightforward. You are lending to corporates. I mean, that has been done since ancient times, right? But you do it in a private format, right? And what banks have been doing for ages, you know, bringing into like a fund format, but it's nothing like overly complex to it. And the third one is really around the risks, right? Because often I think private credit is being sold as the holy grail. You know, basically you're not taking risk, but you're getting outsized returns. Simply not true. I mean, the market is not super efficient, but it's reasonably efficient. If you want to return, you need to take some risks. And that is also part of the story. Still a big believer in the asset class, but I mean, there's some things you need to be pretty straight about.
Yeah, great, thank you. Just a quick one, there are still some seats there, so for all those who are standing and you want to sit down, we have plenty of seats over there, so please feel free to sit, because we still have another 30 minutes. Super, thank you. Nicola, the asset class is often described as opaque. Where has transparency improved, and where does lack of transparency still hide real risks?
So it is described as opaque. I can understand why, looking at the perspective of external investors and not like some of my panelists. I think it's improved a lot, and it's always improving. I think there is a scale with larger managers. It's improving more the information you can get, but it's more old school transparency. So it's not something you find in Bloomberg or just searching the internet. It's more like old style. For us, the allocator used to be the same thing with high yield 20 years ago, I think, in terms of transparency. And so you have to have the resources to go through it and check the numbers. Then it depends on the structures. There is more structure, more advanced, you know, because they have become more popularized, like CLOs has more transparencies, and the bank loans which are standardized, and something is slightly less. But in terms of it, you can get the information around quite simply. And there is a third one, which I think transparency, which a lot of people are scared about, is pricing. And there is a bit less transparency in pricing because there is not a real exchange. But then we should argue if, you know, price transparency is really good or bad, in the sense that there are public bonds that trades at really low prices for no reason and doesn't really give you any information. So the ultimate transparency depends what you're looking for.
Okay, great, thank you. So let's use the comparison between public credit or the traditional fixed income. So what does private debt actually, Serkan, do better than public credit or traditional fixed income, and why has it become such a relevant allocation?
I mean, there are different layers to this question, right? Obviously, we look at it from a mortgage perspective, and there are many different types of private debt. But if you look at Switzerland in mortgages, it's a significantly larger portion of the fixed income market overall. So if you look at bonds, they're about 600 billion, whilst mortgages alone make about 1.3 trillion in Switzerland. So this is almost 2.5 times more. And effectively, if you really want exposure in this overall asset class, right, you can't think away of private debt. And in Switzerland, if you want exposure in Swiss francs, it has to be mortgages. I mean, especially if you want to diversify your portfolio. So that's certainly one reason. The other reason is that actually applies to equities too, to almost any asset class. Public public securities have become less and less. If you look at the listing histories, the volumes that are being traded, they're all coming down. So effectively, it comes to the same. You need to have some sort of a private markets exposure in order to fully participate in the economic upside. And I think it will continue. And the last reason is, if you do it well, it's actually, from a pricing perspective, it's more effective. If you go into, like, let's say, collateralized or mortgage-backed security types of bonds, you have always the fees that you need to pay to the intermediary, to the rating agency, etc. So done well, you actually bring down the costs as well.
Thank you. And Henrik, how do you see this? You have experience in both public and private markets.
Yes, I think the big advantage of private debt is that you have the control of the structure, because it's always bespoke. You have a negotiation with the company you want to lend the money to. So when it comes to documentation, when it comes to covenants, you have the ability to enforce the security you're getting if something is going in the wrong direction. I think that's a big advantage. Then also, when it comes to the downside protection, I think in direct lending, when you talk about unitranche or corporate direct lending, you always have a contractual, predictable cash flow that you're receiving, whereas in the public market, it's like, the yield is moving, you have a market-to-market movements, and I think that can be a big disadvantage. And I think, but maybe the biggest advantage is if you're a direct lender to somebody, you have always direct access to the company, you get a regular reporting, you have access to the management, and therefore you can also identify risks quite early. And as I mentioned before, if you want to, I think it's all about avoiding risks. I think that's something which is really important.
Thank you. Let's talk about the risks and the recent risks back in the headline. We've read it all, what happened in the last couple of weeks, Robert. Are we seeing a structural increase in credit risk? Or is this simply a normalization after years of benign conditions?
I really think it's like a combination of the two. So first of all, I think it's just inherent to the asset class, as I mentioned earlier, and to your point, I think it has been a very, very benign environment over the past 15 years, pretty much since the GFC, because there's always word about, the asset class has been tested. I'm not quite sure that's the case, because, for instance, you had COVID, but you had huge government spending programs, which were basically taking away the heat from lots of the issuers. And I feel that we're now getting, back to a more normalized level. At the moment, I think it's, quite a challenging environment for those that are active in deploying in the asset class, because, you have multiple factors that make your everyday life quite difficult. You have the AI disruption, you have the tariff risk, you have weak consumer backdrop, and the list just continues. And there's like a new challenge that comes up pretty much every month, right? Yeah. So I do think it's a combination of the two, but also like back to the point I made earlier, I think you will inevitably have defaults in that asset class. For the vast majority of private credit, it's non-investment grade. But I think it's just important, and back to also the point that Henrik made, it's important that you basically don't have like excessive losses, right, or excessive defaults, and that if you ever face a default, which is like very natural, that you basically manage that properly. But yeah, I wouldn't say neither one or the other, but some sort of normalization plus at the moment a difficult environment. And maybe last point on that one, I think we will only see over the next couple of years as to how the default and the loss rates really are, because unlike the broadly syndicated market or the high yield market, which are more transparent, in private credit, it can take quite some time, right? You have PIK instruments, you have the absence of covenants in large cap unitranche, et cetera, which means that, actually, defaults can be pushed into the future quite a bit. Also because, yes, it's a single lender, which on one hand is great, but it also means the single lender can, influence quite a bit as to when a default is going to crystallize or not.
And Serkan, from the mortgage perspective, what about default risks there?
And at least what we've seen in our data and from what our investors have in their books, we don't see any structural change in the credit risk. So defaults are almost non-existent in our space. We have, over the last 12,000 transactions over the last like 8 years, we're talking about 2 defaults overall. One went into recovery and was fully recovered. The other one was restructured. So effectively, expected loss on our relatively short history of 8-9 years is 0. So I think, but overall, if you also look in the market, I think from a systemic perspective, I don't see any increased risk. Rates are back again almost at 0 from a government swap perspective. Margins have slightly increased maybe, but effectively the ability to cover the interest rate payments is still very high by the borrowers. Plus LTVs, should it even shift systematically also on the real estate prices, average LTVs are well below 50% if you calculate it on current market prices. So I think there's plenty of buffer. There will be certain segments, like if you have second-rank mortgages, they will obviously be more at risk, and also maybe more recent purchases that might have been fairly high in price. But overall, I don't see a systemic risk for mortgages in Switzerland right now.
All right, very optimistic outlook. When we talk about private debt, we often say or speak about uncorrelated or differentiated strategies. What does that mean in practice, Nicola, with your area of expertise?
Well, I'd like to always answer with a joke to that question. It means that they always goes up and they never have drawdowns. But that's unfortunately is not the truth. I think what uncorrelated in private credit is, apart from the variety of private credit, where we stand more in the corporate side, is differentiated risk you can get, particularly sectors and sector of the economy. So you're normally in private credit, you can get to different sectors and different structures of the economy. The structure that my panelist has already mentioned, so you have ability to have different exposure to different structures, which you can't get in our asset classes. One key thing, for example, was very good in 2022 is having more a floating rate exposure in terms of risk instead of a fixed rate exposure. So you don't have duration, which is one feature of the asset class that made it famous, I think, from 2022. And I think, you can choose. You can go from receivables, which are extremely secured, to equity-like investments in private credit. So you can pick your spots and you can select and be dynamic and add value in that space. So that's the uncorrelation we see.
Thank you. Robert, we see record dry powder and multi-billion fundraising at large managers. Does this lead to innovation, or does it actually dilute the underwriting standards and pushing opportunities elsewhere?
Yeah, might always sound like a bit negative overall today, but I don't see it like leading to any sort of innovation, because I would argue if you have deployed in the past like a 3 billion fund and that now becomes a 30 billion fund, like where is the innovation coming from, right? I think it's what we're observing. There's nothing bad about it, right? But what we're observing is like lots of managers basically pivoting into the large cap side of things. Which is fine, but it's, for me, not innovation, right? You're pretty much doing what you've been doing before, just like larger company size. And actually, you're becoming more and more like the broadly syndicated loan market with bigger clubs, back to the point Henrik made, not really like single or small lender control, etc., right? And then back to the question, does it lead to pressure? I would argue yes, it does, because at the end of the day, the direct lending market, the private credit market is no different than any other market out there. Everything at the end of the day is driven by supply and demand. We have lots of supply via like record fundraisers, lots of dry powder. M&A market is still not great, right? I'm talking now corporate direct lending, plus an investor expectation of, in an ideal world, quick drawdowns, right? And that must create some sort of tension, right? And that does result in like prices going down. That does result in looser documentations, just a matter of fact. So yeah, I'd argue it's more a dilution than any sort of innovation. I think the innovation rather takes place probably in fields like that Serkan is targeting, but those are like usually lower AUM fields. And what you also need to take into account is, direct lending, as it grows, it doesn't only compete amongst itself, it does also compete against like other asset classes, right? It does compete against like broadly syndicated, it does compete against high yield. So we do see some sort of tension there. But at the end of the day, I'm still a big advocate, although it doesn't sound like it, of the asset class. And I think there's, like, especially in Europe, a fantastic segue or like leeway as we move ahead. In Europe, like, bank retrenchment hasn't happened to the extent it has happened in the US, right? So I think, still plenty of growth from that perspective over the coming years. Basel IV, getting in full swing, which would pull back bank lending. So I think the outlook is decent. I mean, I think it's a great asset class, but you always need to take it with a pinch of salt.
Thank you. Looking forward, the next question is a bit twofold. So we're talking about where do you see the most promising growth areas in private debt over the next few years, and what is one risk investors should not underestimate as the market evolves? Serkan, would you like to start?
Thanks. I mean, I think regulation is actually an opportunity for private debt. Every time they turn on the regulatory dial for banks, there's more private debt opportunity because banks start retreating step by step. And it's the same thing we're seeing in Switzerland from a mortgage perspective under Basel III final. Banks have become more restrictive in certain areas for mortgage lending. Also, the fact that the default of Credit Suisse has actually led to outflows of deposits from the market. So banks are struggling to finance all the mortgage demand they get. So for investors who are non-banks and who want to get into mortgages, it's actually a great opportunity because we've also seen margins on a same risk comparison basis increasing. So I think right now is a good time from an absolute, but also from a relative perspective, given that we see negative interest rates on government bonds again on the shorter end. So I think those two are certainly a good reason why to enter it. Risks, I wish I could say there are none.
No risks?
But I think it's been mentioned a few times for now. See, I'm not allowed to talk about risks. I don't know if you can hear me at the back, but effectively it will really depend on how you structure your own portfolio and what decisions you make and how you actually price the loans you're giving out, basically. So I think there's always...
Sorry, we are recording. We need this on.
You need it?
Yes.
Maybe I don't want it to be recorded.
You can talk.
Can you hear me?
Yeah.
Okay. So I think effectively, I mean, idiosyncratically, the investor just needs to make sure that he knows his asset class and that he actually makes sure that he has priced in the risk. I think that's one thing. The other thing is that he continuously monitors his portfolio and restructures where necessary. Thirdly, when it's systemic, then it will start getting more difficult, I think, but then everyone will suffer. So I think to hedge against the systemic risk is always difficult, and I think the best way is then to diversify in different asset classes.
Great, thank you. Henrik, from your perspective, so the most promising growth areas in private debt over the next couple of years, and the one risk investors should not underestimate.
Yes, actually, I go with Serkan, what he mentioned about that banks have so many regulatory constraints and there will be so much place for direct lending, especially for smaller company, mid-cap companies, which wants to grow and needs some flexibility. But I think also with the democratization that LTIF is a big chance in the direct lending market or private debt market in general, because I think it's great to give end clients access to an income strategy, which is quite robust and also fits quite well in the diversification of an overall portfolio, as Mauri mentioned. And on the risk side, I would go with Robert, what he mentioned, that there's a lot of oversupply currently on the direct lending in general in the private debt market. And therefore, of course, that comes at the end with some fee compression, also maybe with some lighter documentation or weaker documentation, and hopefully not too many covenant light structures that would lead actually to a lot of risks, and therefore you have to be super selective when it comes to underwriting risks and underwriting companies.
Super, thank you. So we will have another question now, but in the meantime, you can already think about some questions you're going to ask the panelists, because we're going to open up the floor in a couple of minutes. Nicola, how are investor preferences evolving when it comes to fund structures? Are we moving toward more evergreen, open-ended, bespoke vehicles? How does that look at the moment?
So the evolution is finding a solution to what client problems really exist. And so the fund structures needs to evolve with that. I think there is a bit disconnect between the actual liquidity and terms that clients can take in terms of having their capital locked and their asset allocation and some of the fund structure existing. Of course, there is Evergreen as becoming more popular, but doesn't offer all the full ability. We see more and more pulling effectively a more old style or like a more simple style type of funds of multi-managers where you can enhance liquidity with secondary market and you can use secondaries to enhance that liquidity, so to put all the tools that there are together in a solution that you can have effectively something closer to existing fund structures, although you never get to the UCITS standards, but at least to have reasonable liquidity within 3 to 6 months and have ability of people actually reallocating the portfolio in that frame.
So thank you so far. Now let's open up the floor for questions. We have around 6 to 7 minutes. We have already one. That's super. Kieran needs the microphone back.
Thank you. My question is about private debt for retail clients or private wealth. And what do you think about the recent events in the market with Blue Owl halting redemptions of one of its funds?
Anybody specific or whoever wants to answer? Nicola?
I'll take it. So I think, well, there is always this misconcept that it's listed means liquid and that it goes to retail, and that's true also for some ETFs, by the way. It doesn't necessarily mean just for BDCs, but you're buying a company that lends money. You can see a BDC as a bank, actually just a small bank, and then its price can go up and down if the credit sours or not. The actual redemption got limited to the private closed-end fund, not the BDC, which is listed, so it's not really goes to private clients. Although, I get to my first point is it's an asset class. You need to know quite well to invest, but in various things goes to retail in venture capital type of companies get IPOs. So I'm not going to say that there is a devil in private credit to try to do that. People need to understand what they hold, and then I don't think there is a big push to get it to retail per se by the industry. It's just there are some occasions, and there is limited redemption also in real estate. Until 2 years ago, massive in a lot of real estate funds, and nobody really complained. So it's just narrative at the moment.
Yeah, what I would just add is maybe I think it's an attractive asset class. It offers an illiquidity premium. It is a nice diversifier, as we have just alluded to, right, in a diversified portfolio. But what I would always urge people to do is you need to think about what you're investing into, and you need to understand what you're investing into. And it's an illiquid asset class, as was just mentioned, right? So, and it's also difficult, like with any other market, it's very difficult to time the market, right? So I wouldn't say now is a bad time or now is a good time, right? You just need to be constantly in the market, explore different vintages, or if it's an evergreen structure, keep investing. I think the example you just mentioned is more an example of, it tallies a bit with my opening statements. It should be a more boring asset class, right? It's not about chasing trends and, everyone is about sector A or sector B and then we all rush into that or into that one. It's all about diversification. And at the end of the day, we're not being paid for doing something funky or producing crazy returns. I think this is mainly for other asset classes. And I think if you follow that approach, then it's as said, a good investment class, nice diversifier.
Great, thank you. Some more questions. Here we go, in the middle.
Thank you. You mentioned oversupply as one of the biggest risks. Could you maybe give some concrete example of what to watch for?
So I think the question was oversupply as a risk. It's more in line with what I've said earlier, right? It's just natural. There's so much capital flowing into a market that needs to be deployed. Obviously the risks does increase because everyone wants to be deployed. You need to be competitive in order to find assets. it's just very natural. I mean, personally, I do see, the highest level of competition and the most diluted terms at the upper end of the corporate direct lending market, right? Again, as I said earlier, it's not just competition amongst a few players, but it's also like a competition amongst asset classes. So we see quite a dilution of terms there. So that is something I would watch out for. What I would also watch out for, I'm a bit concerned about like the combination of having an illiquid asset class that you can't trade out of, together with, like I said, the option to basically defer your interest into the future, the absence of covenants. I think that is a combination which doesn't go down too well. So I'd also be a bit, having a close eye on that one, I'd say.
I would like to, maybe just a quick add-on. I totally agree what you're saying, but we also see a lot of syndicated loan players coming more and more now in the direct lending market. And before they were doing large cap companies and syndicated loans, and then we see them now in some auctions where it's about mid cap direct lending. And that there also you see a kind of a spread compression and the weaker documentation.
Yeah, but just, sorry to add, because I'm always sounding so negative, I think we are seeing elevated asset prices across the board, right? I mean, it's not only direct lending, right? You also need to take like a relative value approach. And whether it's like IG, crossover spreads, I think spreads are suppressed everywhere. And the direct lending market, I think, has been moving more in sync more lately with the broadly syndicated market, right? I mean, pricing tended to be more stable in that part of the market for quite some time. And now that it went up in terms of size, there's more correlation in between these markets. But yeah, I think it's just something we all are facing, right?
Yeah, let's bring Serkan in now.
Sorry.
So, Swiss franc mortgages is the opposite. So we don't have an oversupply of capital actually. So that's why we see the margins actually increasing. So that's why there is no dry powder in that sense. So there's plenty of supply on the origination side.
So we have time for one or two more questions. Anyone?
For Robert. Robert, what's the covenant or control right that you require now? Now, what's the covenant or control right you require in mid-cap lending that you didn't require pre-2022?
Well, I mean, I think the bitter reality is that what you can demand is rather going down than going up, because the market has really become more competitive over the last 2 or 3 years. So I wouldn't say like we're demanding something that we haven't demanded before. It's more like trying to defend as best as you can the status quo that you were facing in, say, like the early 2020s. I mean, as I said earlier, I think it doesn't come as a surprise for us. It's just paramount to have like a covenant, a maintenance covenant that also has some teeth in the mid-market, because again, otherwise, stress can happen, very normal in the asset class, but also in line with what I said earlier, you just need to have the tools to then, act in the best interest of your investors to step in when risks arises in order to maximize your recovery. And again, like if you don't have a covenant or a covenant that is worth nothing because the headroom is so uber wide, or there's some other features to it, then that is something we wouldn't support, because I think it doesn't work with the illiquid nature of the asset class.
Thank you so much. I'm sure the discussion will continue in the break. Unfortunately, we are at time. So we need Serkan to have a microphone now for the final round. That's not working, right? The 1, 2, 1, 2? No. So we need this one. Because we close with a quick fire round to bring a bit speed up in here. This means you're all allowed only one-word answers. Are you ready? We start with Henrik in that direction, then we go back and that back. So, first one. Henrik, most attractive sector right now?
Of course, direct lending, corporate direct lending.
Structured credit.
Mortgages.
What a surprise. Robert?
There is none.
ESG, essential or optional, Robert?
Essential.
Optional.
Integrated.
Essential.
AI and private credit, hype or game changer?
Supportive.
Selective.
Hype.
Game changer.
God, at least they use my word. Robert, strongest reason private debt belongs in a long-term allocation?
Diversification.
Risk return.
Adaptability.
All about diversification.
And the final verdict, hidden champion or bubble?
Hidden champion.
Manager-driven.
Hidden champion.
Neither.
All right. If one thing became clear today, is that private debt is not a uniform asset class. It's a spectrum, as we heard, and outcomes will depend on discipline, structure, and selection. I hope those who wanted to increase, those numbers increase, who said we want to increase our evaluation in private debt. Thank you for our panel, for your depth and openness of discussion. Thank you all for being an engaged audience. Enjoy the rest of the conference, and I hope to speak to you later in the break. Thank you.